Hi everyone, this is a short video to explain those required questions. If we make the hypothesis test here, the non-hypothesis H0 volatility equals 0. This hypothesis assumes that the average volatility of the long to short portfolio is 0. Or in other words, there is no significant observable volatility statistically. Alternative hypothesis H1 volatility not equal 0. This hypothesis suggests that the average volatility of the long-short portfolio is not 0, indicating the presence of statistically significant volatility.
Mhm. Hi, now I'm gonna explain how to build the LS portfolio. Long short portfolio is a kind of hedging strategy. It tries to hold both sides of long short position to get a profit in insufficient market. In this strategy, we will normally long what we think it will perform better than the market, and short those may draw down. This benefit is also obvious. That is, it can earn money not only based on the bull market. In this project, we can long the last ranking stock and short the top ranking stock based on its different weighted return. It means the stock selection may be different each time, and then the portfolio will also be calculated. In order to build our coding, firstly, I need Astra transform load data from different data source, and then data cleaning and standardize. Using the read function to get a just close price of a specific stock within a set date, range from CSV file with stock price, then organize them into a pandas series, and then calculate daily return from the price using the daily return function. Figure out monthly return from the price data with the monthly return function. Lastly, combine two set of results into a dictionary using the adjusted function. The second step is calculating the volatility. Volatility is how much the stock price change over time. To figure it out, we can look at how the price have changed in the past. Usually using the daily close price. We calculate historical volatility by finding the average amount price have gone up or down each day. It can help us to understand how risky stock it might be. In our code, we do this with the volatility calculation function. When we set the parameter chat name to vol, it can calculate the volatility for each month using the daily closing price from our data. Then we combine this monthly volatility with the monthly return rate using the merge table function. This make it easier for us to build a portfolio. The last stop is we can really build the LS portfolio. The long-short portfolio involves buying the top performance stock of each month, as we said, and sell the short bottom perform one. So here's this step in our code. We first need to find out the stock ranking. We divide the stock into groups. We can call it quantiles. Each stock is assigned to a rank based on its performance compared to the others. This is this can be done by using the stock sorting function in our code. And then we can construct the LS portfolio based on the monthly return. We buy the top performance, so that is the highest quantile, and sell the bottom one, so that is the lowest quantile. This form the LS portfolio. Monthly return of that could be calculated by the performance function in our coding. That's the whole main process of the portfolio construction.
Hello everyone, now let's move on the inferences we draw from the output of part 9. Firstly, average return is 0.77%, which is incidence. The average return of the portfolio over the period covered by the 235 observations. This is a positive return implying gains, but without context such as return of benchmarks in the market, it is difficult to directly assess its performance. So let's look at the t-statistic. For large sample size, the commonly used significance critical t-value at 95% confidence level is about 1.96. Since 1.3847 is smaller than 1.96, the results are not significantly at the 95% confidence level. This means that there is not enough statistical evidence to state with confidence that the average rate of return observed is different from zero across all possible returns under similar conditions. So for the next part, are the results reliable? I think we can't reject the null hypothesis, but we can't accept it either. The reason is a statistical test cannot accept the null hypothesis. Not being able to reject it does not mean that the hypothesis is true, only that the evidence at hand cannot reject it as true. While the portfolio does produce positive average returns, the lack of statistical significance, as known by the t-statistic, suggests caution. Other factors should be considered when interpreting these results, such as market conditions, investment direction, and risk tolerance. Further analysis of different time periods or different benchmarks. Then my teammate will introduce the last part.
It's about our future to-do list. First, we plan to expand our asset classes. Currently, our strategy is mainly focused on stocks, but there are many other types of investment instruments in the market, such as bonds and commodities. We will start collecting data on these different assets, including their prices and trading volumes. The purpose of this is to test whether our strategies can also be applied to these different assets. For example, we can see if the same investment strategy can also achieve good results in the commodity market, which can help us better understand the universality of the strategy. So move to the next page. Next, we will use a multi-factor model to improve the accuracy of predictions. In the stock market, there are many factors that can affect the stock prices, such as the PE ratio, which is the ratio of company earnings relative to stock price, and the price to book ratio, which is the ratio of stock price to company book value. We will select these key factors and build a multi-factor model that includes them. Then we will use historical data to test this model to see how well it can predict the future stock prices. This step is very important for us because it can help us more accurately assess the value of stocks and potential investment returns. By implementing these plans, we can not only strengthen the robustness of our existing strategies, but also prepare for possible market changes in the future. This means that no matter how market conditions change, our investment strategy can respond flexibly and maintain stable performance. We look forward to improving investment results through this expansion and improvement of these strategies. It will contribute to our future career by giving us the skills of data analysis and optimized strategies. Thank you for listening, and we are excited for our group's future. Thanks.